Purav is a 32-year-old and he is every Indian parent's dream child. He went to a top engineering college, managed to get the 99th percentile in the MBA entrance examination, and now he draws an annual salary of more than 60 lakh rupees. And yet, despite ticking all of these boxes, Purav has always struggled with getting a loan. Just recently, six banks rejected his application for a 22 lakh rupee loan to buy a small patch of land in his hometown in Uttarakhand. To Purav, his low credit score is inexplicable. And this is not just a one off example. Purav is among 8 people that the Ken reporter Ronak Kumar Gunjan spoke to who have been struggling to get loans for no apparent reason. The thing that ties them all together is that they all have absolutely no idea what is hurting their creditworthiness. I'm sure you're familiar with Cibil or Credit Information Bureau India Limited. It is one of the only 4 credit information providers in the country that is licensed by the Reserve Bank of India. And of the 4, Cibil is considered the oldest and the most reliable. What Cibil essentially does is that it calculates your credit score and provides it to banks so that they can judge your credit worthiness. It will assign you a 3-digit credit score between 300 and 900. Usually, anything above 700 is considered good. But this whole process is anything but straightforward. In fact, it is shrouded in mystery. You see, each of these bureaus typically have their own algorithm to compute your credit score, and they are all somewhat similar. But the thing is, nobody, not the borrowers and not even the banks, fully understand how these credit information providers like Cibil actually rate your finances. Which is why we hear of many unfortunate instances like Purav's, where a loan applicant checks all the boxes on paper, they have a steady job, they make good money, and yet their loan application ends up being rejected just because of an inexplicably low credit score. Ronak spoke to another Mumbai based real estate businessman named Ankit Bhasin who ended up in a similar situation. He has been desperately trying to get a 60 lakh rupee loan to buy a house but has been turned down by every bank that he has gone to. Why? You guessed it. A low Cibil score of 600. So now, Ankit is going from bank to bank trying to figure out how to up his score. In this episode, we try to demystify these credit bureaus and their mystery calculations that are deciding the fates of people like Purav and Ankit. Welcome to Daybreak, a business podcast from the Ken. I'm your host Nigdha Sharma and I don't chase the news cycle. Instead, every day of the week, my colleague Rahil Philippos and I will come to you with one business story that is worth understanding and worth your time. Today is Thursday, the 6th of February. You see, Cibil does not give out public information about its calculation methodology. So when we wrote to the bureau, all it said was that while earlier the Cibil score was calculated based on 24 months of a borrower's credit history, last year onwards it changed to 36 months. And that's it. It did not elaborate on the methodology and it did not respond to any of our questions on the opacity of the computation. So then my colleague Ronak went ahead and spoke to 2 former Cibil professionals to get a sneak peek into that mysterious algorithm that decides our credit scores. One of them said that naturally, the most important factor in this whole process is a potential borrower's payment history. Typically, a clean payment history with no delays alone can add up to 300 points to your score. So what happens if you delay a payment? Well, one of the ex-Cibil employees said that a borrower typically loses up to 30 points for every 30 days of delay in payment. And that can really set you back when you decide to take a loan. You see, once a late payment is marked, it takes nearly 24 months for a borrower to return to their previous score. That is 2 years. And that is assuming they do not try to get a new loan or default again. And that is where things went wrong for Purav. Turns out, for nearly 3 years, he had a pending credit card bill that he claims he was never alerted about. And that is where he ended up losing most of his points. One of the former Cibil executives told Ronak that it isn't the amount of the default, it is the duration that matters. So, hypothetically, you could have missed a credit card payment of a couple of thousand rupees, but it will set you back by a cool 100 points if you accidentally pay the bill a few months late. Another factor that Cibil takes into account while calculating your credit score is utilization of credit. Now, this has mainly got to do with credit cards. So, say a borrower has a credit limit of 1 lakh rupees and they spent 30,000 rupees. Their credit utilization rate is therefore 30%. The former Cibil executives said that this is a good place to be. Anywhere below 30% positively adds to a borrower's credit score. Anything above 29% and below 1% affects the score adversely. Funnily enough, most of us assume that the more we spend on a credit card, the better. At least that is what banks issuing these credit cards to us tell us. But overusing your credit card can actually tank your score. Other items like the long term trend of outstanding balances, the ratio of actual repayment amount to the total amount due, and the number of new accounts opened also play a role in determining the credit score. But a borrower has no access to most of this information. Okay, so far we've spoken about what makes you fall down the credit ladder. But what will give you a leg up? More on that in the next segment. Stay tuned. There are two things that will really work in your favor when it comes to your credit score: credit inquiry and credit mix. First, credit inquiry. This is a request that a lender places to access a borrower's credit report. It indicates that a borrower is looking to take more loans. Turns out, Cibil rewards you handsomely when you show an appetite to borrow more. But there is such a thing as too many inquiries. The former Cibil executive said that up to 2 inquiries in a year is a good place to be. More than that could indicate the possibility of overlagging. And in that case, your points could fall. And that brings us to credit mix. So, credit mix indicates the types of outstanding loans that a borrower has. So, for example, credit cards, personal loans, or home loans. Having a healthy mix of every type allows a borrower the chance of a higher credit score. Both of these, credit inquiry and credit mix, are naturally interconnected. Now, typically, when a bank rejects your loan application, they will inform you about your score. And sometimes, to get your score back up, a bank will urge borrowers to take up another loan, pay it back on time, and gradually see the improvement. But more often than not, lenders are indifferent about customers improving their scores. For a bank, a subpar score indicates a risky borrower with a bad credit history. So, if a bank does not reject an application, it charges higher interest rates to cover the risk. Conversely, a low score amounts to higher interest income for lenders. An HDFC executive Ronak spoke to said that it is very common for people like Purav and Ankit to come along with decent cash flow but low credit scores. Banks know that the risk is low for such cases, but they still give out loans at higher interests on the pretext of low scores. Sure, relationship managers will sometimes advise borrowers on improving their scores, but usually even they do not know much about the process. So, one of the most commonly used mediums to improve these scores ends up being credit cards. One wealth manager Ronak spoke to said that in case a borrower is using a new credit card only to improve their score, their best case scenario is to have a utilization rate of under 10%. They should also ideally repay their due credit as soon as possible. Generally, at least 5 days before the due date, because that way, even if there is a delay by the bank in reporting your payment to the credit bureau, you are covered. Now, there have been also cases where borrowers have done everything right, but their credit score is still very low. In some of these cases, they've realized that a loan was wrongly reported in their name or several timely payments were not recorded in the credit report. and unfortunately, they end up being penalized for it. In such cases, bankers advise borrowers to follow the redressal route. Approach the bank to take it up with the credit bureau. But all of these instances point at just one thing: the importance for all of us to be financially literate, to better understand creditworthiness, interest rates, the factors that contribute to loans being approved or denied. But that becomes difficult when the process for calculating credit scores is shrouded in so much secrecy. All things considered, the advice that bankers, wealth managers, and people who work in these bureaus will give you is to maintain healthy financial habits from day one. Because improving your credit score is far more difficult and time consuming than just maintaining a high score. And that is something that people like Purav and Ankit learned the hard way. But you don't have to.
Daybreak is produced from the newsroom of the Ken, India's first subscriber-focused business news platform. What you're listening to is just a small sample of our subscriber-only offerings. A full subscription unlocks daily long-form feature stories, newsletters, and podcast extras. To subscribe, head to theken.com and click on the red subscribe button on top of the Ken website. Today's episode was hosted by Snigdha Sharma and edited by Rajiv CM.